How to trade the moving averages 20 and 50 crossover like a pro. How to trade moving averages 20 and 50 crossover like a pro. We are a monthly chart of Merck & Co. This is a Russell 1000 component. This is an American stock. And the epic is MRK, Mike Romeo Kilo. And we want to discuss today how to trade moving averages 20 and 50 crossover like a pro. Alright? Before we continue, alright, the reason why I'm recording this video is that traders misuse moving averages. So the number one technical indicator that traders are misusing is the stochastic indicator. In my view, the number two technical indicator that traders are misusing are moving averages. And today I want to talk about the moving average 20 and 50 crossovers, because professionals use moving average 20 and 50 crossovers a lot. But when it comes to moving averages, I need to warn traders that moving averages are very, very seductive. They are simple and it's quite seductive. You can think that, okay, it's easy and you can just trade it, all right? Don't get into that trap, okay? You don't want to get into that trap, okay? The next thing that I need to say to traders before we start this conversation, all right, is this. When traders are using moving averages crossovers, they usually forget the price. All right, so for instance, you are trading, the green line is the moving average 20 on my chart, the red line is the moving average 50. So when a trader is using this kind of trading method, very often they ignore the price. So they see here moving average 20 cross above the moving average 50, and they buy. Okay, everything worked well, the price went up. Okay, and here it is, the moving average 20 was about to cross below the moving average 50, but the price is going up. A trader get whipsawed. The reason why trader get whipsawed is that they take, okay, every moving averages, every crossover, okay, so moving average 20 crosses above the moving average 50, they buy. Every moving average 20 crosses below the moving average 50, they want to sell. Sometimes it does not work, sometimes it works. The reason why trader could not filter out, okay, the best moving average crossovers is because they are trading something else. So if you have been following now, you say, George, you said this 100 times. Yes, I did. And I will say it again in the future because it's very important, especially if you are using moving averages crossovers. Okay. So remember, moving average crossover, very seductive. And you don't want to forget the price. Once you get that, we can start our conversation now, okay? So the first thing first, the moving average 20 is what we call, in comparison to the moving average 50, is what we call a fast moving average. So the moving average 20 is faster than the moving average 50. And the moving average 50 is faster than the moving average 100. And the moving average 100 is faster than the moving average 200. So if I choose two different moving averages, and I call one X, S for X-ray, and I call the other one Y, okay, I will say that the moving average X is faster than the moving average Y if the moving average X is inferior to the moving average Y. What do I mean by inferior? So 20, number 20 is inferior to number 50. So when you're using moving average 20, okay, you compare the moving average 20 to the moving average 50, because 20 is inferior to 50, you will say that moving average 20 is faster than the moving average okay, 50. So anytime you are comparing two moving averages, the one that is, okay, inferior will be, okay, faster than the one that is higher. Okay, so we clarify that now. Okay, if you have any question, put in the comment section, and in due course, I'll record another video to answer your specific question. Okay. So the moving average 20 in this case, the faster moving average in comparison to the moving average 50. So what I want you to understand, I want to share a few things with you. So think of it of two cars, okay? One is very, very fast, all right? Think of it like, okay, Formula One car, racing car, that is driving on the motorway instead of being on the racing course. You have a Formula One car at the highest speed on the motorway. And that faster car is hitting, okay, a car that is at a lower speed. Now, if you think of it, there will be a burst of energy. All right, pay attention carefully because I want you to get this thing in. Once of all, there's a burst of energy. There will be a kind of explosion. A car that is very fast going, for instance, 200 miles per hour, hitting another car that is going at 50 miles per hour. There will be a burst, an explosion. There will be, okay, a burst of energy in that point in time. All right. The same thing we see when we have a faster moving averages hitting a slow moving average. So the crossover is similar to what I'm describing to you now. And the reaction you will see in the price. And that burst of energy, all right, pay attention, burst in that energy is quite amplified very often when we are using a moving average 20 and 50. Those two moving averages create a lot of energy. Now, I say to traders that when it comes to moving averages, I have too many secrets that I don't want to talk about in a public place. But I want you to get the message clear because, in fact, I'm writing an e-book about moving averages. If I have time, all right, I'll finish that e-book and I'll publish it. Okay, now, so you understand now. So a faster moving average crossing above a slower moving average, we create a burst of energy. Now, remember, when it comes to the moving average 20 and 50 crossover, is amplified. That's it. You get it now. Okay, let's move on. So very often, when you are using the moving average 20 and 50, when the moving average 20 crosses above the moving average 50, as you see here, very often the price will be up. Why? Because of the burst of energy that I'm talking about. The price will be up like this. Remember that. Just remember that whenever you're using moving average 20 and 50, in fact, the moving average 20 and 50, we can use it, crossovers, we can use it to determine the best overbought and oversold. So, for instance, though the moving average 20 is crossing above the moving average 50, it's a bullish crossover. But at that point in time, because of the burst of energy, the price will be in the overbought zone at a resistance zone. So when you hear the word overbought, think of a resistance level. The price will already go up to a resistance level. This is one example here that I have here. You can see that when he was crossing, the price was already up here. So if you buy here, generally people lose because the price is already up, is in at a resistance level. Remember what I said to you, when traders are using moving averages, they forget the price, they forget to draw channel, they forget to draw resistance, they forget to draw trend line, and they are trading moving averages, and they get whipsaw because they are trading the moving averages instead of the price. Don't do that, okay? Don't fool yourself, okay? Very bad attitude, all right? Quote me on that. That's a very bad attitude. You see, there is a resistance here. You see, price found a resistance here, resistance here, resistance here, and now when the moving average 20 was crossing the 50, the price was at a resistance level. Now you want to buy here when the price was already up. And then people buy like this, they say, moving average 20 cross is a bullish, I'm buying. Last time it worked, I'll buy again. And now here it is, as they bought it there at a resistance level, price start going down. Because those who are trading the price know that the price is at a resistance level, They are looking for weaknesses to sell, and you are buying because moving average 20 crosses above the moving average 50. You are trading the moving averages instead of keeping your eyes wide open on the price. So you see now? You see what I'm saying? So here it is, there will be, but so if you understand this, we can use, okay, if you are scanning for stock that are overbought, we can use the 20 and the 50 crossover. But remember, this phenomenon that I'm describing to you here is not always the case. It's not 1 + 1 = 2. Sometimes you may not see it like this. So I will say to you, 70% of the time you will see like this, that when this is the normal, in a normal market, when a moving average 20, especially for dynamic bullish stocks that are going fast, financial instruments that are moving fast, okay, talking about moving average 20 and 50 crossover, it creates a lot of energy, and the price will be already out before the moving average 20 will cross the 50. Because what is happening? The moving average 20 is highlighting the short-term trend. It's highlighting, okay, in fact, we can say intermediate trend between the short-term and the medium, okay, intermediate trend, all right? So because the momentum is increasing from the short-term to the medium, or intermediate trend is increasing, there is a surge in momentum, all right, before the moving average 20 will go above the moving average 50. Remember that professionals usually use the moving average 20 to sell. You see here, they were selling on the edge of the 20 like this. You see, we are on the daily chart. So anytime the price rally up, display a lower low, and rally up to the moving average 20, they are selling. You see how they were selling along the moving average 20, the price couldn't go above the moving average 20. So it's like a barrier. They use it to sell like this. So to allow the moving average 20 to go back above the 50, you need a lot of energy, a lot of bullish force, a stronger bullish force to push the moving average 20 back above the moving average 50. Therefore, when the moving average 20 is crossing the moving average 50, usually the price is already at a resistance level, and people want to buy. It's the wrong time. So the best approach is this: when the moving average 20 crosses above the moving average 50, the best approach, in fact, you can look for an opportunity to sell using a top-down trading method. So moving average 20 crosses above the moving average. Okay, moving average 20 crosses above the moving average 50, and the price is at a resistance level. Implement a top-down trading method to look for an opportunity to sell. But remember that sell is a contra trend. Okay, you may decide not to sell. You may decide not to trade it at all. You can wait. You can see this on the daily chart like this. I trade this sometimes. You see this on the daily chart. You see a bounce at a resistance level. I know that a lot of people will be trying to sell. I just want to make sure that the price is at a resistance level, very important level. Though it's a bullish side setup, people will be busy trying to sell here. And then you implement a top-down trading. Don't just sell it. Don't just sell it, okay? Draw the line like this. So you see, this is my warning line. I'm saying priority to bullish signal above and priority to bearish signal below. You use a top-down trading method. If the signal fell, come out. Like daily chart like this, I can use a daily chart, hourly chart, 10-minute time frame, okay? All right? Here it is, okay? So when the best approach is when the moving average 20 goes above the moving average 50, wait for the price to pull back. You see here, they pull back. So generally when the moving average 20 crosses above the moving average 50, price at a resistance level, then the price will try to pull back to retest the moving average 50. That's what's happening here. So understand the message. This is what's happening very often. The best, okay? If you are trading moving average 20 and 50, this is the best setup. You hit a resistance at the point when it was crossing it, a pullback, okay, near the moving average 20, then implement. So here, as it pull back near that level, you can draw your warning line again. Always use your warning line. And then implement a top-down trading method to buy. If you are buying, your first target is the first and nearer resistance level. See here? Boom. So swing trader, day trader can apply this. You can apply this on the hourly chart. So you can use, okay, combine the hourly chart and the 3-minute time frame, all right? Okay, so you see this setup and then you go on the 3-minute time frame to enter your trade, okay? So you can see this on the 2-hour time frame or the 4-hour time frame, those set up, okay? And then you wait for the pullback, the movement 20, 50, moving over 50, and then you implement a top-down trading method to trade it. Pay attention to the resistance ahead, you see here, how the price stop here, okay? Very, very powerful. So, understand how to trade the moving average, okay? 20 going above the 50. The opposite is also true in a downtrend when the moving average 20 D below the moving average 50. All right? What usually takes place, you see that the price will already go down to a support level. So the price will be at a support level, will already be at a support level. So because I explained it to you already, there will be a surge in momentum to propel, to push the moving average 20 below the moving average 50. Because professional buying before on the edge of the moving average 20, now to push it back below the 50, you'll see that the price will be already down and will be at a support level at a time when the moving average 20 is crossing the moving average 50. In fact, at that point in time, we can use the moving average 20 crossing the move below the moving average 50 to determine oversold asset. So if it happens, you see that you can scan moving average 20 crosses below moving average 50, you are looking for oversold because the price very often will be at a support level, and you will see that the stochastic will be oversold. But remember, this is a risky trade because the price is going to go down, but you want to take a contra trend, a quick profit, a contra trend. So if you don't want to do that, stay away from it. So what we are looking for is this. We want a price, so moving average 20 crosses below moving average 50, price already down at the support level. What you are waiting for is that rally to pull back to the moving average 50. You see here, when we cross this above, it was at a resistance level, and we wait for a pullback near 50. And then we implement a top-down trading method. This is how one should trade the moving average 20 and 50 crossover like a pro. So in a downtrend, if it goes down at a support level, now you can wait. If you don't want to play the contra trend to buy it back to the moving at 50, you can wait for that rally to the moving at 50 and then implement a top-down trading method to sell it. Now, we do use moving averages, but what I want to say to traders, what I communicate to traders all the time is that the price is the number one indicator. If you look carefully here, you will be surprised. There are two things that I say to traders that the price is doing constantly. Break above, retest, turn around, break below, retest, turn around. So when traders are using moving averages, remember what I said to you, that when traders are using moving averages, crossovers, they forget the price. But when the price is doing all the time, it will be below a support level, break below that support level, and we come back and retest that support level. All right? And from there, we implement a top-down trading method to sell it down, okay? That's what the price is doing all the time. Break below, retest, turn around. And you will see it's happening all the time. Or the price will break below the previous low and retest the previous low in a downtrend. Or in an uptrend, the price will break above the prior high and retest the prior high. Okay? So you see here? Look careful here. That's what the price is doing all the time. With that, you can look for the best setups. Those are the most reliable. You see this high here? So price going up, yes or no? For me, higher lows, higher high, see? There was this high here, this high here, this high here. Look what the price did. You see this high here where I put the red line? Look what the price came back all the way to retest that high. You see this high here. Those are why, this is why you want to look for. Break above, retest. Retesting the prior high. Okay, or retesting the prior low in a downtrend, and then you implement a top-down trading method. So if you are using moving averages, remember what I just said: break above, retest, break below, retest. What has happened here? You see this moving average crossover here that we are talking about, 20 and 50. At this point, if I pay attention to the green line here, okay, I'm going to color it now into green, and I want you to focus on that line. Okay, it's too gray now. Make it a bit dark. That's it. You see that dark gray layer. You see this there. Okay, what the price has done. This was, you see this low here. You see this level here. It's a support level. You see here was a support level. Well, this support level. Okay, this one here. Price went above it. You see that level. It was a support level again here. Oops, I'm moving my line. Okay, was a support level here. Probably for the support went up. G below, retested here. That level went down, went back above, came back to retest that support level here. Now the price again went above that support level and it was retested here. You see, so moving average 20 crosses above the moving 50, and the price was breaking above a support level, the green line, and was retesting that green line. So, in fact, somebody who understands that the price is doing two things most of the time, break above, retest, turn around, may not even need the moving average 20 and 50 in order to find the best setup. So what the price has done, it breaks above the green line and retests here, and it just moving average 20 crosses above the moving average 50 here. So in a downtrend, when you are using your moving average 20 crossing below the moving average 50, you look for break below a support level or break below the prior low and retesting the prior low, and then you implement a top-down trading method. Very simple. And with that, you will start using the moving average 20 and 50 crossover like a pro, because now you will avoid the mistake of trading the moving average crossover and you will be focusing on the price. Though the moving average crossover is very seductive, you won't be seduced at all. You will focus on the price and you keep eyes on the price. And when you see a false moving average 20 and 50 crossover, you will ignore it. Okay? Now, as I explained to you, the burst of energy that we see when the 20 crosses above the 50, all right, is not happening 100% of the time. As I explained to you, 70% of the time you will see that burst. So I will have another example because I don't want to, okay, how do I put this to you? I don't want to overwhelm you with too many examples. That's why I want to be specific. I'll show you this example. This is what usually happens, and this is how you want to handle it. That's it. Okay? Not too much blah blah blah. I want to show you another scenario when the moving average 20 was crossing a 50, but there was no burst of energy. Okay? Let's bring that one out now. Okay? I'm talking about a stock, APK PFE. This is another American stock. PFE, Pfizer Incorporation. I prefer to say Pfizer. Traders say to me, no, George, is Pfizer. I prefer my word, Pfizer. All right. Okay. Now here we are. We are on the daily chart again. You will see that very often because professionals use the daily chart when they apply the moving at 20 and 50. So if you want to look for the best setup, use the daily chart and the moving at 20 and 50. It works better on the daily chart, also on the hourly chart. Daily chart, okay? So here, this is a different example. Here it is. You can see that I want you, because I don't want to show you all, because there are some false moving average crossover. I don't want to talk about those ones. I want to go to the point, what I want you to know and to understand, okay? So here, the moving average 20 was crossing below the moving at 50. Normally, the price should be at a support level. Yes or no? That's what I said to you in the first scenario. Yes or no? But here it is not at a support level. Can you see when it was crossing? See here, when it was crossing, it was not at support level. Why? Because the price was already at a support level. So the price already went down to a support level. All right? Here it is. It already went down. There was the burst of energy that I'm talking about already took place. So the price was already at this support level. You see, this support level. Okay? If the burst of energy that I'm talking to you about is already taking place, and the moving average 20 is crossing below, and the price is at a resistance level, this is what I call ready-made, okay, moving average crossover. Now this one is ready. You don't have to wait anymore. You just implement a top-down trading method. But you will only see this scenario, okay, probably 30% of the time. Because the first scenario that I show you, you will see more than 70% of the time. But this scenario, the burst of energy before the moving average crossover, you will see it probably 30% of the time or 40% of the time. All right, so remember that. So this is an unusual situation, okay, a bit old, that the moving average 20 was crossing the moving 50. You will see that also when you have a consolidation. during a consolidation phase. You can see that that's where you will see that. You see here the price. We can see that the price is consolidating between this line and this line. So when you see this odd situation where the moving average 20 is crossing below the moving average 50 or above it, and you don't see the surge of the momentum, okay, as I explained to you in the first scenario, check it out. Am I in a consolidation phase? But this one is also good because there was already a surge that propelled the price to a support level. And when the moving average 20 was crossing 50, it was at a resistance level. Which resistance level? Okay, put a line there. Always draw a line. Okay, when you see setup, draw a line there. So which resistance? Yeah, this resistance here. See here, where the price went up, hit it, boom, come down, boom, pull back, okay. All right, so this resistance here. It was also support before. Okay, that's where we are. So what the price did, you see that resistance, this one here, where the price touches here and come down. So that line, if I call it now into red, remember what I said to you, two things the price doing all the time, break below, retest. All right, that's what the price doing all the time. So price D below it here, so below that red line, you see here, it's coming down, isn't it? From a resistance level. In fact, it was consolidation, break below that level. Now it came back to retest it. All right, here we have a bearish trading setup, but we don't just sell because the price can continue to go up. That's why it's very important to use a top-down trading method to control the risk. Otherwise, if you just sell, the price may continue to go up. You say, oh, George, please, George. All right, this to make you laugh a bit. All right, so you don't panic. Okay, implement a top-down trading method here at this point. So this is. You will see this scenario 30 or 40% of the time when the moving average 20 crosses below the moving average 50, all right, you may see, okay, this scenario, but it's not frequent. You may see that only 30% or 40% of the time. In this case, you don't have to wait because the price was already at a support level before hitting this level, okay? There's another example here that I want you to see. Okay, scenario. This one, was it this one? Because I don't want to waste my time on, this one. Bear with me, please. Want to focus on the best examples. Was not very good, this one. This is not a very good example of a downtrend. Okay, anyway. Now, what I want you to understand, yeah, if you accept this one, okay, yeah, if you accept this one, that the price, you see here, you see this one, this crossover here, I want you to focus here. Let's zoom into it. Okay, this session here, where the moving average 20 was crossing below. This is not a bad example because you can see that the price again was already at a support level, was pulling back to retest this level when the moving average 20 was crossing below the moving average 50. You see here, near the red line, and the price went down. But what I was trying to show you, this is also a good example because as you can see, the price was already down very fast. You see, what increase in the momentum. And then the price pulled back to retest this red line, you see, so support level, break below, retest, and at the same time, the moving average 20 was crossing below the moving average 50. Okay, so this is also different from the fixed example that I was showing you. This is what I call a ready-made moving average crossover. All right, so that's all. All right, you get it now? That's all. So the first thing first, moving average crossovers trading method are very, very, okay, seductive. But do not get fooled with them. Do not trade the moving averages, okay? When traders are trading moving average crossovers, especially moving average 20 and 50, they are spending most of their time trading the moving averages instead of trading the price. Don't do that. Two things the price doing all the time, break below, retest, break above, retest. That's all. And then we implement a top-down trading method. As I demonstrate to you in this video, 70% of the time, when the moving average 20 crosses above the moving average 50, we see a burst of the price action, a faster momentum, increase in the momentum, and the price will rush to a resistance level. In fact, we can use that to determine the best overbought that we can sell for a contra trend, which is a risky trade. So the best approach, as I showed you in the first example, is when the moving average 20 crosses above the moving average 50, and the price is at a resistance level, all right, we want the price to pull back near the moving average 50. In fact, to pull back to the resistance level that the price breaks above. So usually you see break above a resistance level, and must retest that resistance level, and then we implement a top-down trading method. That's the best approach, okay? But on the other hand, if the moving average 20 crosses below the moving average 50, generally the price will go very fast to a support level. In that case, we wait for the price to rally up to a resistance level or to a previous support level before we can sell. What is happening is that we are looking for price to break below a key level and to rally up to retest that key level before we sell. If that's not the case, we wait, all right? So if the moving average 20 crosses above the moving average 50, but the price is not retesting, okay, a support level after breaking above it, we will wait. All right. On the other hand, if the moving average 20 crosses below the moving average 50, okay, and the price is not retesting the prior support level, which means break below, retest. If it's not doing that, we wait. Because in order to sell after the moving average 20 crosses below the moving average 50, we want to see that action break below, you see here, the red line, and retest it. Now this is ready, okay? Now implement a top-down trading method. Don't just sell or buy. Always use multiple time frame trading method. This is about trading like a pro. The difference between ordinary traders and the professional traders is that professional traders always use multiple time frame trading method, all right? So this is just to explain to traders how to trade moving average 20 and 50 crossover like a pro. If you have any question, put in the comment section. Any suggestion, put in the comment section. And in due course, I will record another video to answer your specific question. I will be also talking in the next few days about how to swing trade using moving average 30 and moving average 50 crossover like a pro. In that case, I will be sharing something completely different that you want to know about the moving average 30 and the moving average 50. As I explained to you at the beginning of this video, when it comes to moving averages, I have too many secrets that I do not want to talk about in a public place. But those are the things I can talk about in a public place. All right, it makes sense? It is also powerful. We are the TSTW24 traders talking about how to trade moving average 20 and 50 crossover like a pro. See you in the next video when we will be talking about how to swing trade using moving average 30 and moving average 50 crossover like a pro. Happy trading to you all, and speak to you soon.